We think international equities bring long-term, enduring benefits to portfolios. However, most U.S. investors are significantly underallocated to non-U.S. stocks in our view. To illustrate, the slide shows the market breakdown from a variety of perspectives. The pie chart on the left is from the IMF, and it breaks down global GDP by country. You can see that foreign countries make up 3/4 of global GDP. The chart on the right is the country breakdown of the MSCI EAFE Index. Here, non-U.S. stocks represent 42% of the global equity market. So the GDP chart shows the percentage of the U.S. in terms of the global economy, and the MSCI chart shows the U.S. as a percentage of the corporate world. Yet mutual fund asset data from Morningstar, shown in the middle, shows that foreign stock funds account for only 1/4 of the assets in equity mutual funds, and this home country bias has been in place for many years. The investment team at Harbor Capital Advisors believes that U.S. investors may not fully appreciate the benefits of international diversification, so we'd like to take a brief moment to share why we think non-U.S. stocks merit a meaningful strategic allocation in investors' portfolios. First of all, international equities offer important diversification benefits by bringing exposure to different industrial cycles and economic forces. This slide compares the sector composition of the S&P 500 with that of the MSCI EAFE Index. The U.S. index favors technology in a big way, whereas the international index is more broadly distributed across sectors. The MSCI EAFE has more exposure to areas like industrials, consumer staples, materials, and financials, more cyclical areas of the economy that have been traditionally labeled as value, as shown on the right side of the slide. In contrast, the U.S. index has grown increasingly biased towards those sectors thought of as growth. So including an allocation to international stocks helps investors round out their sector exposures and helps offset some of the sector and style tilts that come from a home country bias. International equities also bring another element of diversification to the table that's often overlooked: diversification of income. With bond yields extremely low, investors need a variety of tools to meet their income needs, and we think international stocks should be a part of that toolkit. This chart plots the time series of yields for the 10-year Treasury, the S&P 500, and the MSCI EAFE Index. The dividend yield on the international index has always been greater than the U.S. index, and it has exceeded yields on the 10-year Treasury for more than a decade. Granted, the economic impact from the pandemic prompted a few dividend cuts from both U.S. and non-U.S. companies in 2020, but equity yields still remain well above that of long-term bonds. International markets have always had more dividend payers than the U.S., and the practice of paying dividends is just more entrenched in many foreign countries. Therefore, we expect the dividend opportunity set in international markets to remain much larger than in the U.S. We also believe that dividend yields will likely increase back toward historic averages as the global economy gradually comes back online. And this is also an argument for favoring active managers in international markets, particularly managers that seek quality, financially strong businesses with the ability to continue to pay dividends even during difficult times. In sum, we think international equities improve an investor's portfolio and merit a meaningful strategic allocation. They may enhance overall portfolio diversification and can be a good source of income.